WeWork's bankruptcy, a dive into its multi-dimensional aftermath and the real estate sector's road ahead. The recent news of WeWork's filing for bankruptcy represents a significant inflection point in the world of commercial real estate and startup ecosystems. Once pegged at a staggering $47 billion valuation, WeWork's precipitous fall sends ripples across multiple sectors, highlighting the fragility of overvalued, unicorn companies and the volatile nature of investor sentiments. This blog post delves into the economic, socio-political, and environmental ramifications of this event and examines the potential future implications for stakeholders. Through a blend of substantiated data, expert analyses, and relevant case studies, we will explore how the real estate sector can navigate this upheaval and what strategies could be employed to mitigate adverse impacts. Economically, the downfall will have immediate effects on the commercial real estate market, particularly in urban centers where WeWork was a significant tenant. Data from real estate services firm JLL indicated that prior to the bankruptcy announcement, WeWork was one of the largest lessees of office space in New York City. Real estate experts point to a WeWork effect, where the failure of such a high-profile tenant could lead to tighter lending practices and a re-evaluation of tenant quality, not just occupancy. This can result in stricter lease agreements and an increase in demand for established businesses over startups in the commercial real estate market. WeWork's business model, which involves long-term leases and short-term rentals, has come under scrutiny, spotlighting the gig economy's impact on job stability and the broader market. However, the bankruptcy also presents an opportunity for the real estate sector to reassess the environmental sustainability of office spaces, particularly as vacant WeWork properties may be repurposed for other uses. Looking at similar situations, such as the downsizing of other shared office spaces or the dot-com bubble burst, indicates that market corrections can foster innovation and resilience. This may lead to a healthier ecosystem of startups and a more stable real estate market. Emphasis on sustainability. Property owners could retrofit vacant WeWork spaces to meet higher environmental standards, making them more attractive to environmentally conscious tenants. WeWork's bankruptcy is not just a tale of a company's rise and fall. It is a harbinger of broader economic, socio-political, and environmental shifts. WeWork's bankruptcy represents a significant turning point in the commercial real estate and startup ecosystems. In this blog post, we will delve into the economic, socio-political, and environmental ramifications of WeWork's bankruptcy and explore potential strategies for the real estate sector to mitigate adverse impacts. Economically, WeWork's bankruptcy will have immediate effects on the commercial real estate market. WeWork was one of the largest lessees of office space in New York City, and its absence could increase office vacancy rates, which were already under pressure due to the rise of remote work during the COVID-19 pandemic. Real estate experts point to a WeWork effect, where the failure of such a high-profile tenant could lead to tighter lending practices and a re-evaluation of tenant quality in the commercial real estate market. Sociopolitically, WeWork's business model has come under scrutiny, highlighting the gig economy's impact on job stability. From an environmental perspective, WeWork's bankruptcy may present a setback for the company's initiatives to create sustainable workspaces. However, it also offers an opportunity for the real estate sector to reassess the environmental sustainability of office spaces. Looking at similar situations in the past, such as the downsizing of other shared office spaces or the dot-com bubble burst, it is clear that market corrections can foster innovation and resilience. This may lead to a healthier ecosystem of startups and a more stable real estate market. To navigate the post-WeWork era, the real estate sector should consider implementing strategic adaptations. These strategies include diversifying the tenant base to spread risk, offering more flexible space options to accommodate changing business needs, retrofitting vacant WeWork spaces to meet higher environmental standards, investing in smart building technologies to make properties more appealing in a market with increasing remote work, and supporting startups through incubator programs to create a robust tenant pipeline. WeWork's bankruptcy is a significant event that has far-reaching implications for the commercial real estate sector and the startup ecosystem. The economic ramifications of WeWork's bankruptcy include a potential surge in vacant properties, leading to a drop in rental prices and a recalibration of property values. The socio-political factors involve job losses, affecting household incomes and consumer spending, as well as triggering regulatory discussions around employee and investor protection. From an environmental perspective, WeWork's bankruptcy presents both setbacks and opportunities for the real estate sector to reassess the sustainability of office spaces. However, the long-term implications may lead to a shift towards more sustainable business practices and a focus on profitability over growth. To navigate the post-WeWork era, the real estate sector should consider strategic adaptations such as diversifying the tenant base, offering flexible space options, retrofitting vacant spaces to meet higher environmental standards, investing in smart building technologies, and supporting startups through incubator programs. Ultimately, WeWork's bankruptcy not only poses immediate challenges but also opens the door for the real estate sector to redefine its role and emerge more resilient and forward-thinking.